Gold has officially entered a historic moment, and if you think what we've seen so far is impressive, the real story is what comes next. Right now, gold is trading at all-time highs, levels that many people believed would take another decade to reach, and this isn't happening by accident or hype. It's happening because the global financial system is quietly shifting under our feet. For the first time in years, gold isn't just reacting to fear, it's reacting to structure, policy, and long-term economic reality. To understand where gold could go in 2026, you first need to understand why it's rising now, because this rally is not speculative, it's foundational. Gold rises when confidence in paper systems weakens, and today we're seeing pressure on every major pillar of the global economy at the same time. Inflation has proven far more persistent than central banks expected. Interest rates are high, but no longer effective at controlling debt. Governments are running record deficits, and geopolitical tensions are forcing countries to rethink how they store and protect wealth. When all of this happens together, gold doesn't spike. It reprices higher permanently. One of the biggest drivers behind gold's all-time high is central bank buying, and this is something most retail traders completely underestimate. Central banks around the world are buying gold at the fastest pace in modern history, not for speculation, but for protection. Countries are actively reducing their reliance on the US dollar, increasing gold reserves as a neutral, non-sanctionable asset. And once central banks buy gold, they don't sell it back into the market. That removes supply permanently and creates a long-term price floor. At the same time, interest rate expectations are shifting. Markets are increasingly pricing in rate cuts heading into 2026. And this matters because gold thrives when real interest rates fall. Gold doesn't yield interest, so when bonds and cash lose their advantage, gold becomes far more attractive. Even the anticipation of rate cuts is enough to push gold higher because markets move ahead of policy, not after it. Another major factor pushing gold to all-time highs is global uncertainty, and this isn't just about wars or headlines, it's about systemic instability. Governments are struggling with debt loads that cannot realistically be paid back without either inflation or currency debasement. History shows us that whenever debt reaches this scale, gold eventually rises because it is the only asset that exists outside the system. Stocks depend on earnings, bonds depend on trust, currencies depend on policy, but gold depends on none of that. It simply exists, and that's why it becomes more valuable when confidence erodes. Now let's talk about what this means for 2026, because this is where the conversation gets serious. Most people assume that after an all-time high, a major crash must follow. But that assumption is based on speculative markets, not structural revaluations. When gold breaks into new highs during a cycle like this, it often enters a multi-year expansion phase rather than a quick reversal. Many major financial institutions are already projecting gold prices significantly higher into 2026, with some forecasting ranges between $4,000 and $5,000 per ounce, not because of hype, but because the macro conditions justify it. If rate cuts materialize, if inflation remains sticky, if geopolitical risks persist, and if central banks continue accumulating gold at current rates, then higher prices are not just possible, they are logical. That doesn't mean gold will move straight up without pullbacks. Volatility will remain part of the journey, but the overall trajectory points higher unless something fundamentally changes in the global system. And here's the most important part that most people miss. Gold's rise is not just about price, it's about a shift in how value is stored. Younger generations are entering markets that are increasingly skeptical of fiat currencies. Governments are facing trust issues, and investors are looking for assets that cannot be printed, frozen, or diluted. Gold fits that role perfectly, and it has done so for thousands of years. While technology evolves, financial instruments change, and currencies rise and fall, gold remains constant, and that's why it continues to reassert itself during periods of transition. Going into 2026, gold is not just an investment, it's a signal. A signal that the world is preparing for slower growth, higher uncertainty, and a more fragmented financial system. Whether you trade gold, invest in it, or simply watch it as a macro indicator, understanding why it's rising now gives you insight into where the global economy is heading next. This isn't the end of gold's story, it's the beginning of a new chapter, and the next 2 years could redefine how the world views money, value, and financial security.